Hey, welcome in everybody. Today we're going to talk about how Winter Storm Fern changed the course of natural gas storage for 2026 and possibly even 2027. So let's go ahead and dive in. I've got a little presentation here, so if I'm looking this way or this way, I'm just getting some information. So we're going to talk about how it rewrote the prices for natural gas and kind of the fundamental nature of natural gas for the next 2 years. So there was a lot of quiet expectation around this storm building from last week, and then we had a massive shift. And late last week, natural gas in the last 10 days has gone from $3 on the February contract, $3 up to 500, $5.80. Cash prices were upwards of $25 just over the weekend. So we're just dialing this in. I'm recording this on Monday, so there could be some follow through. There could be some follow through that happens over the next couple of days. So anyway, this is a massive shift, and nobody noticed until it was already on us. So while America checked frozen pipes, traders watched prices explode. The weekly price surge was over 63%. This is the largest price gain that we've had in a week since 1990. So these expectations and these volatile times in natural gas, they really create havoc with extreme temperatures like this, because what happens is production it is taken offline and they have what's called freeze offs. That natural gas itself doesn't freeze because it's a gas component, but when gas comes out of the ground, it comes out of the ground with commingled with crude oil, with natural gas liquids, and water. So that water actually freezes equipment, and so many producers in advance of storms like this start taking off wells that may have some water components in it. Each well is going to be independent of one another. Some are relatively dry, some are relatively wet. And when you're talking about dry or wet, kind of depends on if you're talking to an engineer or somebody on the marketing side or on the financial side. They may be talking about NGL content. So what this does is it creates a supply shock with all this supply going offline. Roughly 10 to 15% of the US supply as of Monday, I'm recording this on Monday, was taken down over the weekend. So 10 to 15% of the US supply was taken down. Now, there was some incremental imports from Canada, but in addition to that, it also has downstream effects, because when consumers are offline, that takes demand down. So there is a supply response and a demand response. And when you're looking at the demand response, you got to look at the customers that have outages, because heat is really delivered via two mechanisms. One is electric heat and the other is natural gas heat. In many of the colder states, natural gas heat is used as a basis for getting the temperature up in people's house. In a gas furnace, it's much more efficient and quick. However, a lot of people in southern states and states that don't have as many winter storms, electric heat is what happens. Now, when you're looking at that, that has impact when those customers are offline. Also, LNG exports are down. So as much as 10 to 15% of the US supply is down, about a third of our LNG exports are down. So what does this do? It creates a supply shock and a demand shock. So a lot of the traders are trying to figure out which way is up. But essentially, this translated into the futures market on the February contract, heading up by 63%. So this wasn't noise, and this wasn't the market realizing something broke. Or this was the market realizing something was broke. Prices spiked, and inside our service with our rogue members, we've been talking about it for weeks, for months even, that 1 week can change the course, pardon me, 1 week can change the course of the entire winter or the end of season storage, which a lot of traders look at as kind of an anchor for where prices are going next. For example, when we take a look, we have a storage projection tool inside of our Rogue Edge platform. So you can see this storage forecast just based upon the 3-year average was set to exit the storage season. I think this was too high, but on 3-year averages, we were going to exit the season above 2 TCF. Now, just with this storm, 1.6. Most of the analysts had us at about 1.9 TCF on end of season expectations. This storm took us to 1.6. So that's how quick the market can change. And to give you a frame of reference, 1.6, I've even seen 1.5. But the last time that we were at, say, 1.6 is we did touch it here, but really 2022. And for those that weren't in the natural gas market in 2022, during this summer period, in this period of time, natural gas went up to $9. Now, I'm not saying that's going to repeat. I'm not a financial advisor. Read all the disclaimers below. But I'm saying that if we exit the storage season this low, we are going to have a price response. In 2026, the entire year is changed just by this storm. So this is a 400 BCF swing. 1/5 of our safety cushion is gone. So 400 BCF, let me take you back to here. This swing took us from here to here, or really here to here, 1.5 TCF. So that's kind of where this storm left us. So it's a 400 BCF swing. 1/5 of our safety cushion is gone. So there was a pre-storm forecast of 1.9 TCF expected in storage by end of winter. This was an amalgamation of probably 40 different analysts in the natural gas market that kind of specialize and focus on this. Post-storm, there's projections 1.5. I've seen 1.4 to 1.7. So I've seen some that only have throttled it back to 1.7. But I think most all the analysts, including myself, are probably 1.5 to 1.6 TCF. So that's a 21% loss of the safety cushion. And this is in a matter of days or within 10 days. So one thing that we've been saying is 1 week can change winter. So that's a key. So the production freeze off that nobody expected at the storm's peak, over 10 BCF of natural gas went offline. So that is as of Monday. We may have even more of it in the next couple of days. So this is from freeze-offs, and like I said, when natural gas comes out of the ground, it does have natural gas liquids, crude oil, and it does have some water components with it. And there's separation equipment on the surface that separate the water from the other elements. Well, the problem is that separation equipment is exposed to the weather. So when you have production in North Dakota, it's a little bit more weather resistant because it's built to sustain the weather. But what's tricky is there's a infrastructure trade-off when producers are producing things in Texas and in Oklahoma. It's less winterized. It's winterized somewhat, but a little less winterized. So this went from freeze-offs and wells froze, gathering systems. And when you hear freeze-offs or wells freezing, it's not freezing inside the ground. It's actually freezing the equipment that enables it to come out of the ground. So processing plants, that's another bottleneck. When processing plants have problems, then you can't get the natural gas separated from the natural gas liquids. What that means is without that separation, that's not something a utility can use for gas furnaces. So that is an important factor to realize. So flirting with records. Now, this is phenomenal. We're estimated right now, as of Monday, again, for the week 123, January 23rd through the 30th, 375 BCF. This is going to change throughout the week. Obviously, I'm recording this on the 26th, so we're only a couple days into the week. But the number of times in history that we've seen 300 BCF plus, 4 times. And the last time that we saw a record here was in January 2018, 359 BCF. What this means is this is going to change. Now, this is measured for the week from 123 to 130, but that's not reported until February 5th. So storage is released for natural gas every Thursday, and every Thursday EIA releases that number. That is for the previous week that ended the previous Friday. So bear that in mind when you're looking at this. You're not really going to see the storage number until February 5th. I think that's the day. Let me look at a calendar real quick. Yeah, February 5th. So on January 29th, or tomorrow, since this is going to be released on Wednesday, you're going to see the week ending 123. So it's going to look significantly different than these numbers that that you're going to see. So you're going to have to wait a week to see what the absolute numbers are. By the end of the week, we should have a pretty good idea of what that is. So that is for the week ending January 30th. But the key takeaway is there's only 4 times in history that we've seen above 300 BCF, and this is significantly above. This might be a record week. So the front contract. So when you're looking at natural gas, many people look at the trading element for natural gas, and you look at the front month, or that means the most recent month. So when we're looking at it, February has been the contract that has been trading. That is actually expiring today on Wednesday, the 28th. So the front month, February, went from $3, roughly $3, all the way up to 5. I think at its peak was 580, right? So that was a massive plus $2, almost a doubling of it inside of a week. Now, what's interesting is that's the Feb contract. Now, what's important to look at is the time that this happened, most of the trading activity was shifting away from February and into March. So what happened in March? March went from 260 up to 360. And it's currently trading about 370 right now. And again, I'm recording this on Monday, but this shows you a little bit more of what I consider reality, because when you have parabolic moves like this, sometimes another factor that comes into play is positions. Futures contracts are either long or short. Somebody either owns it or is short it, meaning they have to buy it back. Well, there was a pretty significant hedge fund short, and I think that contributed to part of it. Again, not a financial advisor, read the disclaimer, but pre-storm, a February contract was trading about $3, and in the peak panic, it was between 520 and 580, which was a 50 to 65% jump in just a couple of days. So I'm watching more the March contract, and the March contract is probably settling around 360, 370, somewhere in there. So it's important to understand when these events happen, which contract is getting affected and why. So the entire forward curve has been repriced. And here's why that matters. It resets the table for 2026 and 2027. When we look at history and we look at the fact that the last time we may be this low was 2022, and natural gas ran all the way up to 9. Now, 2022 also had Russia invading Ukraine, and EU prices for LNG went through the roof. So you got to bear that in mind. So it's probably not going to be the same, but it's going to reset the table a lot higher for 2026 and 2027. and the supply response isn't coming fast enough. Let's take a look inside of Rogue Edge one more time. This is our net on how much natural gas we're growing or declining. And let me go right here. We are growing each month about 400,000 a day, or 0.4 BCF. But if we're going to need a BCF or more, we're not going to be getting it. So drilling has already been slowing, and sub $3 prices has made new wells at the wellhead, has made new wells unprofitable. Producers have been pulling back for months, actually over the last year and a half, and we're probably going to have about a 6 to 12 month lag time. And in EIA, they cut their forecast recently on 2026 dry production to 107.4 from 109.1 last month. So they're already projecting supply dropping in 2026. Meanwhile, demand isn't slowing, it's accelerating. Power demand, data centers, AI, all of it, power has increased so significantly that they are leaning on renewables, they are leaning on nuclear, but they're also leaning heavily on natural gas. Natural gas has risen significantly on power demand over the last 4 years, and that's expected to continue. 2025 didn't grow that much. Now, part of that could be weather, part of it could be capacity on AI, but our domestic demand is increasing, and we have increased LNG exports as happening in 2026 with Golden Pass. Now, in another session, I talked about LNG and how I'm concerned about global crowding of LNG. So I'm just talking about capacity here. But that crowding is happening and will impact it, and that's why it's important to stay on top of the market. And listen, if you or your business is impacted by the price of natural gas, you should get educated. And that education, I know we built solutions for that. EnergyRogue.com, you can go to it. You can also click the link below and get to this page. Just enter your email and your first name, and you will get Mastering the Oil and Gas Markets in just 5 minutes a day. So that is a good tool to use. It's an ebook. I think it's about 30 pages, something like that. And yeah, 39 pages. So anyway, click the link below. It's totally free. So so listen, I hope to see you inside. Would love to hear from you. Combined with this, natural gas is not just local anymore. It used to be a US thing. How much US supply, how much US demand. Well, now we're exporting 6 to 7 BCF a day to Mexico via pipe, and we're exporting probably 23% of our US supply in LNG, and that is only increasing with increased capacity. So that means close to 25, 26, 27% of the US supply base, or the US production, is actually being exported to other countries. That means 25%, 1/4 of the US supply base, is actually priced internationally. And if you're not staying on top of those trends, it's important to watch what's happening in Europe and what's happening in Asia. That is where our LNG goes, as well as Mexico for pipelines. So the European storage is about 48% full, and that is showing a lot of concern. And there's been a significant lift on TTF prices, which is European storage, or European price. That's the benchmark that they use for LNG prices. And we've seen that lift recently because of a combination of increased weather demand and lower storage. So the simple math is this is a multi-year setup. Less gas in storage, slower drilling response, growing power demand, and more LNG exports. So this is setting up for a multi-year shift. So 2026 just shifted from Two, you might want to pay attention. So if you or your business is impacted by the price of natural gas, it's important to get educated. And I know I've been trading natural gas markets since the mid 1990s. So it's important to stay on top of this. And we've built tools to, we built tools and subscriptions to cover that at a reasonable rate, because I was spending close to 30 plus hours a week tracking all these different things, and I finally built a solution so that I could digest the market in just 5 minutes a day. So if you're interested, go to energyrogue.com. You can learn a little bit more about our products. But in the meantime, go ahead and sign up for the ebook. But anyway, the winter storm Fern really just changed the table. So it's not just going to be about weather, it's going to be about supply disruption. How long the supply is going to be down. Again, I'm recording this on Monday. We'll have to see. But at the end of the week, we're going to have a pretty good idea. And our Rogue members, I deliver videos like this inside twice a week. And at the end of the week, I'm going to be having another video where we're going to talk about the actual demand impact and the supply impact. But this changed storage by over 400 BCF. And if you just have to look at this stage, this is what it went from and to. I mean, this is a massive shift. This is based on 3-year averages, but this gap is big. So when we're looking at this, it is going to be big. So listen, my name is Brian. Thanks so much for listening. I try and keep these short and ran a little bit over. I usually try and target about 15 minutes. Drop a comment. Let me know. Let me know if you enjoy this. Also, let me know if you have a topic you want to cover. We cover natural gas, crude oil, refined products like diesel, motor gasoline, natural gas liquids, and electricity. So if there's a topic you want to hear from, just let me know. So listen, thanks so much for tuning in, and we'll talk soon. Bye.